This is the presentation of my financial feasibility analysis model used to compare three scenarios that the client needs to decide between. In short, the first option is to rent out the unfurnished apartment on a year-to-year basis using the service of a rental agent. The second is to rent out a furnished apartment on a short-term basis through Airbnb. And the final option is to sell the property through an agent and invest in a portfolio of maximum 3-unit trusts using the services of a financial advisor. All assumptions are included in the model, and risk and uncertainty provisions will be highlighted throughout the video presentation. So, to start off with, for options 1 and 2, we have to evaluate when to replace the stove and whether or not we should replace the carpets with laminated flooring. For the stove analysis, I calculated the NPV for the different months in which the stove can be repaired based on the parameters of the cost increase per month. From this we can see the sooner we replace the stove, the better. In the flooring analysis, the flooring will cost 35,000 Rand, but we will need financing for this. At a later stage, I'll get into why we chose to use a bond for financing, but for this analysis we are weighing up if it is worth doing. With the given parameters of cost of financing, we will have to finance a cost of 35,001.75 Rand at prime plus 0.75%. In a year, we will have to pay 3,762 Rand interest, but with this investment, we will be getting an extra income of 9,600 Rand. From this, we can see that we are going to make an additional income of roughly 6,000 Rand. And hence, we suggest to install the new flooring at the end of December 2018 before the new tenants start in January 2019. Before we get into the evaluation of models, in order to compare options 1 and 2 with 3, we are going to analyze options 1 and 2 as if we will sell the properties at the end of 5 years. This is merely to take into account the total value of each option. It does not mean that the plan is to sell, it is just to compare. A little bit more admin before we continue with the options. So, on to why we chose a bond to finance our costs. In order to decide how to finance the additions of investments into a stove, flooring, plumbing, etc., I did the following analysis. Evaluated the value of the bond taking into account that we were told that there is currently 400,000 Rand left to still pay back on the bond. I then looked at the scenario where we take all additional costs like plumbing, painting, floors and the stove and cover it with a bond to see what our monthly repayments will be. In adding that all together, we get a total of 457,000 Rand. And over 24 months at an interest rate of prime plus 0.75%, we get to a monthly total of 4,639 Rand per month. To explore another option of financing, we take a personal loan where all the additional costs would be covered by this loan, with the loan's interest being 11.75%. Because the bank sees her as a risk, as she is a single parent with only one stream of income, she will not have a lending rate of less than prime. After looking at the loan over common loan periods, we can see that this option comes second to the first financing choice. We can also look at a credit card option, but we can disqualify this off the bat as this option, as credit cards have a much higher interest rate of around 20% plus. Because we only have a 5-year horizon and because it is the most feasible option, the best is if the client takes a 20-year bond to pay off her debt, but then only uses this bond facility for 5 years out of the 20. So for option 1, if we can focus on our cash flow here, we first calculate the before tax cash flow, and after that we will calculate the after tax cash flow. Then we will look at the property sale as per the disclaimer discussed earlier, and then we will take everything back to present value at 4.75. I did quick calculations to find out what increased percentages I will use in terms of levies, rates and rental incomes. I looked at historical figures in all cases and the average percentage change. I then also used the percentage increase in rental amount as per what you could expect in the environment. Back to the cash flow. We have a constant bond payment per year as we were told that the interest rate would be constant. I did research to find out what the rental agents charge and found this to be 8% of the rental income on average, which is an industry standard. The model makes provision for repairs and maintenance, which will increase by inflation per year. With this information, we can calculate the end of period totals. Moving on to after-tax cash flows. The depreciation for this property was calculated on the straight line method and applied to the floor and the stove. On operating expenses, here we can see all of the costs involved in order to make money. From this, we can determine her taxable income and also her personal taxable income, increasing her salary by 7% per year, as evident with this calculation. After this, we can calculate the net taxable income that she is liable for in her personal capacity. As we can see, the property decreases her taxable income, meaning that she will effectively get a tax rebate at the end of the year. After this, we can calculate the net value of her income after tax. The net present value after the 5 years shows that she can get 4.15 million rand. Then looking at selling the property, taking into consideration that the property value will increase by 4.75% per annum. And in order to provide for risk and uncertainty, we can assume she will get 95% of the value. The model also took into consideration the expenses involved with selling the property. These are the costs involved. So, in conclusion, for this option we can see that the net present value is 4.9 million rand. Option 2 is very similar to option 1. The same methodologies were used to calculate rental amounts, rates and taxes. The only difference between the bond for option 2 and the bond for option 1 is that it is higher due to having to buy furniture for the apartment. In the cash flow, we can see an addition of Airbnb rates. Percentages were found through research. The tax elements were also calculated the same as in option 1. The difference being that the operating expenses is a lot higher because of the expenses involved in running an Airbnb apartment. I found a similar apartment on Airbnb and saw that it could be rented for 750 rand a night. The model once again took risk and uncertainty into consideration and stated that the occupancy rate for this apartment would be 75%. This occupancy rate is built into a number of calculations, including cleaning services. Besides the addition of extra costs, the rest of the cash flow is worked out in exactly the same manner and gives us an MVP value after 5 years of 5.2 million rand. So for option 3, in selling the property immediately at 920,000 rand, taking into consideration risk and uncertainty and applying a 95% factor, we get 864,000 rand. We then less the expenses and plumbing, which gives us an NPV after selling the property of 815,736. We then take this amount and invest it into 3 unit trusts. We decided to invest money into an Investec equity fund, a BCI equity and an Allan Gray equity A fund. Each of these trusts have very high returns. These returns already net for the financial advisor fee, which we decided to be 1.5% of the fund return. This is also an industry standard for certain brokers. I then calculated if each unit got 271,000 rand when the property was sold, their growth collectively for all 3 would have been close to 500,000 rand after taking out the initial investment of 815,000 rand. Because this amount was a growth on investment, it has to be taxed. After calculating the tax as per this section and subtracting it from the investment, we can get the total value that she will receive from investing, which is 292,000 rand. If we bring this back to the MVP of 250,000 rand and adding her salary, this option will have an NPV value of 5.076 million rand. So in comparison, we see that the net present values after 5 years for the 3 options are: for option 1, 4.96 million rand, for option 2, 5.18 million rand, and for option 3, 5.076 million rand. Option 2 is feasibly the best option for her to take. The downside to this option is that she will have to work very hard and it may be difficult to manage the Airbnb as she has moved. Other considerations she will have to take into account is that for option 1, it is a problem if you cannot get a tenant, and for option 3, you can access your money easier as the money is in unit trusts. Better if the next 5 years has uncertainty for her.